Okay, so very good morning. Welcome to the briefing then for Monday the 15th of August. Hope you all had a fantastic weekend. Just getting stuck into what's happened this weekend then and what to look out for predominantly for this week, because one word of warning, today is likely to be very, very quiet in terms of market conditions, in volumes, and potentially translating into very subdued market movement. Not only because we're in mid-August, so the height of kind of thin trading conditions for summer period, but it's Assumption Day in Europe. So most of the mainland European countries are either shut or traders just won't be in at work. So desks will be skeletal systems and trading staff. So likes of Germany, Spain, Italy, France, Austria, Belgium, Greece, to name a few, all affected by this holiday. So again, it's probably going to be very quiet. Also, from a data point of view on the intraday, very little until later. 1:30 we get the US New York Empire State Manufacturing. That's kind of your sole data highlight, if you like. But nonetheless, just getting stuck into the situation at the moment. Looking at a bit more broader context, I've got the S&P shared here on the bottom left. This is slightly longer dated because what I'm trying to do here is encapsulate the whole of last week. So from the 8th all the way through to Friday. After we had that stellar non-farm payrolls reading, that was the kind of jump up that we had there at the end of that week. And then we've kind of consolidated into this range of 21.67 and 3/4 up to 85.25 on the upside. Of course, that level being I think that was on Thursday, just before the NYMEX pit closed, is now the all-time high. And this morning, we're trading about a tick shy of that level. You can see, though, the range here, certainly on Friday, things got very quiet and only around a kind of 10-tick kind of low to high trading range. One of the bigger reasons, though, for some of the more recent upside has been the pushing back once again of Fed hike expectations. You did have, of course, on Friday, as you saw, the US retail sales report came in at 0%. Let me just share with you what that looked like on the historicals. So we had a 0% print. That was below the expectations of 0.4. Weaker than expected across all the readings, ex-auto, gas, and the control group. So again, pushing back any expectation of a near-term hike from the Fed, certainly from this year. Again, expectations were for a 0.4% reading, and it was the first flat print that we've had in the last 4 months. Looking as well in terms of the week as a whole, where we stand with the S&P, quite an interesting statistic I saw this morning. Just in regards to the S&P, rallied for the 7th consecutive week. S&Ps have rallied for 7 weeks in a row, adding just over 8%, making this the biggest 7-week gain in 19 weeks. The sequence of weekly rallies last extended to 8 weeks, so we need one more up week. Last time it did 8 consecutive weeks was back in June of 2014, so it was some time ago. Again, back in also a similar summer type trading conditions environment. Some of the reasoning then for why equities have been trending higher, apart from the monetary accommodation angle, has been crude oil. So Asian shares overnight were all positive, actually trading near 1-year highs in the Asian market. Oil continues to be on the upside, a pretty strong driver for market sentiment. The Shanghai Composite overnight jumped by the most since May, as takeover speculation outweighed Chinese figures showing a slump in new lending. The yuan weakened by the most in a month, and US crude climbing for a third day. Looking at this chart, rising crude prices are helping support stocks. As I was saying last week, given the fairly light calendar for economic data releases, traders kind of looking for a driver of the market to kind of gauge sentiment and direction, and oil has been a fairly decent correlation to then guide stocks in direction. And as oil has been moving up, as the equity market, as we said, printed all-time highs on Thursday evening. So here you can see the blue line mapped over the MSCI All-Country World Index, and as we've been climbing from late July, early August in crude, it's been taking global equities with it. So as I said, global equities trading near 1-year highs. One thing that we have seen already this morning is a further uptick in crude oil. Now this is a top left here, 15-minute chart for WTI crude futures. Did see a bit of a move, fairly aggressive at 8 o'clock. We broke above $45. Now looking slightly longer dated, we continue to power higher after that initial low print. A couple of days there at the beginning of August where we flirted below 40, but pretty short-lived. And it's interesting to see then that more vocal kind of threats of coordination, a potential action to counter these low prices seems to be paying off from the likes of OPEC and non-OPEC nations. A tweet I've just seen this morning that came out on Reuters, which caused that latest kind of pop in prices above 45, was this one on Reuters this morning. Russian Energy Minister Novak said consulting with Saudi Arabia and other countries to achieve oil market stability. Remember, this is really key when Russia comments. Russia and Saudi are really the two that have the propensity to move the oil market, given that they're the two world's kind of dominating players from a production point of view. And for any type of impactful deal to be struck, it needs to include the likes of non-OPEC country Russia, not just Saudi and the OPEC nations. So at this present point in time, as I was suggesting, they seem to be doing a pretty good job of verbal intervention at this point in time to push the oil price higher. And ultimately then you kind of think that, well, there's no real need for them to talk about freezes when you can do the job of that by actually just intonating towards that. And obviously looking upside, it was that pretty swift fall that we had initially from around 50, which doesn't look particularly clean here technically. So potentially if we can consolidate above 45, further upside can't be ruled out from here forward. A quick look then at the calendar for this week. As I mentioned today, market holidays across much of mainland Europe, so it's going to be pretty quiet. But one thing I want you to focus on this week is the UK and potential then for sterling currency to see potentially some of the better movements out of the various asset classes. Certainly as a single FX currency, there's a couple of big events to get over. Tuesday, CPI, PPI and RPI. Then Wednesday, UK average earnings unemployment rate and claimant count rate. Thursday, retail sales, and then UK public sector net borrowing. So Deutsche Bank making a good point with the UK data. It's kind of the first major glimpse of hard post-Brexit data. So following a raft of weak sentiment surveys released so far, we then get the inflationary readings. They'll be tomorrow. They're going to be quite key going forward. Obviously a key metric for the Bank of England, particularly to see how much of an impact a 12% trade-weighted decline in sterling since the referendum has had, as to future clues to whether higher inflation and to how aggressive that higher inflation will be, given the weakness in the currency post-Brexit. You can see here, slightly longer dated, obviously we had the big flush lower post the referendum night. That original low then was seen a few days after at 128.06. And since we broke beneath that kind of mid to late July support level around 130.67, we've been on a gradual trend lower and sitting comfortably beneath 130 this morning. It only really seems a matter of time before we test that post-Brexit low. Certainly this week I think we can test that, given the importance of some of the data, tier 1 nature coming out this week. Barring today, you've pretty much got important UK data coming out every day this week. So that's going to be certainly one to watch. Once we start breaking those post-Brexit lows, then could see some further aggressiveness to the downside. There's been some other housing data that's come out as well over the weekend, still asking some pretty big questions about the health of the housing sector or appetite for purchasing in this new economic environment as well. And you can see here, it's starting to get substantially below now those price or pre-financial or post-financial crisis lows we had back in the fallout of Lehman Brothers. One of the other big events for this week is we do get an inflation reading out of the US. I believe it's on Tuesday, and this obviously is a front run then for the FOMC minutes we get on Wednesday evening. Now, this is Deutsche Bank's report, and they stress a good point as well. The FOMC raised interest rates last December. It inserted an important phrase into the meeting statement. They said, quote, "In light of the current shortfall of inflation from 2%, the committee will carefully monitor actual and expected progress towards its inflation goal." So with the labour market very close to meeting its maximum employment mandate, as per the situation you could argue now, given the strength in non-farm payrolls for 2 months now consecutive, the Fed is emphasising its inflation goal as a litmus test for further steps toward policy normalisation. But as you can see here, in their view, underlying core inflation pressures will remain muted for a substantial period of time for 3 reasons, one being real GDP growth is a leading indicator for core inflation, and that's in a continuing downward trend. Remember, although jobs is strong at the moment in the US, retail sales was poor, but more importantly, the GDP figure that we had was very, very weak. 1.2% was less than half of the consensus estimate when it came out for Q2 growth in the US. And if that's any kind of lead indicator, as you can see here in this chart from Deutsche, the dashed line is real GDP. You can see that big drop that we've had more recently. If that's a lead indicator, then certainly inflation is on the downward trend from here on out. And that's going to be problematic for the Fed to look to hike into that type of environment. So again, pushing that off the cards is probably the most likely scenario. And you would argue then that potentially, fundamentally, that's an overall supportive trend for equities still to push on to these all-time highs. So the core inflation data coming out of the US, CPI data on Tuesday, is also going to be very important for you guys to watch. And of course, you've got the minutes coming out on Wednesday evening. Another important US event on, I think it's Friday, you've got Walmart by sales, the world's biggest retailer. They're always a bellwether as well for not only consumer spending, but if you're trading the Dow future, that's going to be one to look out for. They report pre-market.